In today's episode of the Wealth Talks podcast, we talk about the cash value in life insurance policies, what it is, where it comes from, and how to use it. This episode is all about things cash value.
Life insurance cash value is one of the lesser known financial assets that you can own, but it is also one of the most powerful.
After this episode, you will know more about life insurance cash value than you ever have before.
A question we frequently get is, what is cash value? And cash value is a representation of the part of the insurance that you have completely paid for in your life insurance policy.
You don't have to get to the end of all your payments before there's a part of it that is completely paid for.
It's like a mortgage. Every time you make a payment, you own a little bit more of your house. Every time you make a payment on your life insurance, you own a little bit more of the death benefit that you're purchasing.
So cash value in life insurance is very similar to equity within your mortgage.
It is. Where when we look at term insurance is never owned. It's always leased or rented on a year-to-year basis, sometimes on a month-to-month basis. But you never build ownership in that. It's always just something that if you stop the payment, there's no more death benefit.
So let's take a look at how long it takes to develop this cash value in life insurance.
And it depends on how the policy is designed, because you can have what is called base whole life insurance, and that's not going to build cash value very quickly, but it will build that equity that we're talking about. On the other hand, you can build that equity much faster and have a policy that might be called a single premium policy, where you pay one premium, you buy a chunk of death benefit for life, and that's going to have a very high amount of equity. It would kind of be like buying your house with cash.
Why don't we just start with that? Why don't we just plunk down some money and be done with any payment?
There's a couple of reasons why we don't do that. Number one, most people don't have that chunk of money. And number two, if you do that, now you've got a problem with taxes because you have created a modified endowment contract as far as the Internal Revenue Service is concerned. The insurance company doesn't mind that, and you will have a high cash value, but when you go to use it, it's going to be treated as if it was 401k or IRA money.
We might as well avoid the tax situation.
Absolutely.
So this gives us a few different policy designs. We can go with the base only whole life insurance policy. We'll build equity, but slowly. Or we can add what is called paid up insurance as a rider on that base policy. We don't have to increase the premium. We can just adjust the premium so that it's about the same overall. And so if we look at a couple of different policies that are designed this way, if we have the base only policy, these policies were each designed to take about $100,000 in premiums that are put in over a period of time. And then once that $100,000 has gone in, we stop premiums. So you're not putting any more into either one of these policies. If we look at the first year here in the base policy only, base whole life insurance, you put $10,000 in, you have zero cash value in the first year. What do we have in the paid up policy?
Yeah,
the paid up additions.
The same $10,000 premium, but in the first year we have cash value of $6,831.
That's a huge difference.
That's over 60% of what you paid that you get back in cash value.
And the reason that we have cash value in this paid up addition policy is we've purchased paid up insurance, where in the base premium, it all went to the death benefit. And so the death benefit is actually going to be higher.
Death benefit is much higher on this policy.
Well, let's compare those then.
The death benefit in year one on this policy is $804,383.
Big difference here. It's on the policy with the paid up additions rider, so we're getting the higher cash value. The death benefit is only $215,000, so $281,215.
That is a big difference.
This brings up a really good point that Nelson Nash always said, who was the founder of the infinite banking concept. He said, if you design a policy with high cash value and a lower death benefit, then you will be able to use those cash values during your lifetime. And by the time you get down to where you're probably going to die, you'll have more death benefit than if you started with a higher death benefit on the base policy.
And that's true. We're going to see that on these numbers. Right now, the death benefit on this policy that I have is higher, but on the one Mom has, it's lower now, but it's going to be higher later. We're going to see that happen here. So if we fast forward to year 5, in year 5, This base only policy has $32,175 of cash value.
Oh, mine still wins 46,191. And we've still paid the same premium, 50,000 each. But I have the 46,191.
Go to year 10. I have $76,416 of cash value.
I have 80,160.
You're still ahead on cash value.
But something I'm noticing different is you have paid 100,000 by year 10. And mine was designed a little differently. So I've only paid 79,000 and my cash value is 80,000.
And that's because of the way we had to structure the premiums to get these different type of policy designs. So both policies are going to take $100,000. Yours just has to take a little bit longer to get it all into the policy.
Okay, but at year 10, I've paid much less
You
and
pay
I have
much
more
less, and
cash
you
value.
still have more cash value.
I have
yes.
more cash value than you. I also have more cash value than what I've paid in premium. And we're just looking at the guaranteed values. So I am guaranteed to have more cash value.
How much does your life insurance cost you at this point? If you walked away from that,
Well,
you would actually get money back.
that's incredible.
I wouldn't yet. I paid $100,000. I only have $76,416 in guaranteed cash value. Now, let's go out to year 35. This was a 30-year-old male in great health. So 35 years from now, he's going to be 65. Retirement age, or what many people think of it as retirement age. I have $144,657 of cash value.
I have 175,763.
You're still
guaranteed.
ahead on cash value.
So you both have put in $100,000. You have $47,000 more than what you paid for, and you have $75,000 more than what you paid for in your policy, Michelle?
Yes.
So those are guaranteed numbers, and you've been talking about the guaranteed numbers versus what? What's the other option in a whole life policy?
That's the non-guaranteed numbers. And those are you get dividends, or you may get dividends. They're not guaranteed, but they share the profits of the insurance company with the policyholders. And so you can earn dividends along the way.
And that brings up a great question, because people ask, well, how does the policy grow? Well, one of the ways the whole life insurance policy can grow, we get these guaranteed cash value growth. That's what is guaranteed by the insurance company. But in order to give us that guarantee, the insurance company is making investments. They're taking all the investment risk, so we don't have any of that risk coming to us. But if the insurance company makes a profit, because this is a mutual company and a participating policy, we get to share in the profits of the insurance company. So when they make a profit, they have to share that with us. That's the dividend coming back in. And when we have that go to buy more paid up insurance, it increases the size of the policy. That's what these projected values are. Projected values, I have $297,900 at age 65.
Is that the cash value?
Cash value.
Okay, so then my cash value at age 65, the projected value, $338,177.
You're way ahead.
177.
Let's look at the death benefit, because this is the base only death benefit on the projected side. I have $522,152.
And mine is $592,698. So it's just like you mentioned, Tom. The death benefit is higher on the policy where we didn't get the highest death benefit initially. But by the time we're closer to dying, it's much higher.
John, you've used the word projected, and that's just because these are non-guaranteed values when you're talking about projections, right?
Yeah, we can't guarantee the insurance company is going to make a profit.
That's important when we look at buying a policy. We want to look at a company that has paid dividends consistently over the last 100 years, because dividends aren't guaranteed, but they sure are nice when you get them.
Yeah, the icing on the cake.
We've talked about how you get life insurance. We've talked about how the cash value develops in it. But something that often comes up in our discussion is, well, what about the cash value in this IUL policy, or this universal life policy, or my variable universal life policy? And when we talk about universal life products, we're talking about a completely different type of cash value. Oftentimes that's considered accumulated cash value. It's accumulated because the cash value in those products, those universal products, are just overpaid premiums that have earned interest. The insurance company has charged you extra money than what is necessary to provide the coverage, and then you've earned an interest rate on it. That's why those are called accumulated cash values.
With cash value this great, people often want to know, well, is there a way I can make it even better and pay my $10,000 but get more cash value than what we've shown?
So you paid $10,000 and got $6,800 in the first year, yes, there is a way that you can pay $10,000 and have maybe more like $8,000 or $9,000 in the first year. But now we run into that tax issue that you were talking about earlier about the modified endowment contract. That policy would be taxed differently unless we add a term insurance rider onto the policy to artificially boost the death benefit so we can get that extra cash value in there. It is possible to do that, but that term insurance is going to come with a cost.
Term insurance is not like base insurance. It never converts to paid up insurance. It doesn't build cash value. And so that's an added cost to the policy. And that added cost then drags down the internal rate of return of the policy for the rest of its life. It's important that we understand all these ramifications before a policy is purchased, because just having the highest cash value we can get may not be the most important way or the most beneficial way to create a policy.
While the numbers would look exceedingly good in the first years, as we went down and looked at the numbers later in the policy, they wouldn't perform as well as what we have right here. And that would be the concern.
John, you've done some research on this and shown that if you're just looking for high cash value and you're never going to borrow from the policy, then a term policy could be okay.
A term rider.
Term
term
rider,
rider.
you can, yeah. In some cases, when you add that term insurance rider on and put extra money into the policy initially, in some cases, it can actually increase the internal rate of return on the policy. But if you're going to use that money over your lifetime, then you're going to have extra interest in those first few years too when you borrow that all back out, all that higher cash value. And that's what tends to drag down the internal rate of return.
So if someone was just putting the money in there, setting it, forgetting it, just kind of locking up their money, then that might be
It might work.
reasonable to put that term rider.
But most people looking for 90-10 policies are wanting to get the cash value in there to borrow against it sooner. And so you got to think about the strategy involved here.
Now that you understand what cash value is, where it comes from, and how to get it, we're going to talk about how to use cash value right after the break.
While we're on break, I wanted to ask you to review the Wealth Talk show on Apple Podcasts. Over the years, we've received several reviews. Most of them were positive, but there are a couple negative ones. And Apple, for some reason, is choosing to feature those reviews, so it looks like our show has a 2-star rating. We're hoping by getting some more recent reviews, Apple will feature those and reflect a more accurate rating for the show overall. So please go and review the Wealth Talk show on Apple Podcasts. We appreciate it very much. Thank you.
One of the most common ways of using cash value is by taking a policy loan.
It's important to realize that a policy loan is not borrowing your own money. It's not borrowing your cash value. It's using your cash value as collateral so the insurance company loans you their money. And because the insurance company is loaning you their money, there is an interest charge associated with a policy loan. That interest needs to be paid annually. It's simple, meaning that it's only charged once a year and it doesn't compound unless you don't pay the interest on your anniversary of the policy. Then it's going to be added to your loan balance, and that would be compounding against you.
You always want to pay the interest unless, in some cases, you decide not to for a certain period of time as part of your overall strategy. For example, if somebody has a credit card that's charging them 19% interest and they can get a policy loan for just 5% interest, then it would make sense to borrow from the life insurance policy, even if it takes a few years, get that credit card paid off, let the interest compound on the policy for a couple years while you pay off that credit card. Now what you've done is you've transferred the debt to a lower interest rate. Then you go ahead and start making repayments back on that. Now you're only paying 5% instead of the 19% the credit card was charging.
And
So
when
that's
you
a strategy where you might want to let the interest compound for a few years.
a lower interest rate than 19% or 26% or whatever the interest, what are we looking at right now in life insurance policies? The interest rates where between 4 and 6% somewhere?
On many policies, some policies I've seen are as high as 8% right now. Usually those policies with the higher interest rates, like that 8%, are going to be sharing some of that back with the customer in the form of the dividends, because there are going to be companies that group all the policies with policy loans together for purpose of distributing that dividend.
Well, it's certainly lower than the interest rate someone would be paying with credit card debt. So it would make sense to allow that interest to compound with the insurance company if needed. But generally speaking, unless someone's in that position, you want to pay your loan interest every year when it's due so that it's not compounding against you.
If you think about it, there's three ways that we can buy anything. We can borrow the money, we can save up and pay cash for it, or we can save up in a financial tool like life insurance, borrow against it, and do a type of self-financing like we're talking about here.
I was just talking to a client last week and they're paying 26% interest on their credit card. And when we mentioned you could borrow this money from your policy and only pay 4.5%, it was like, aha. And it was done like just as soon as possible because he realized that 4.5% was a whole lot less than 26%.
Now, what if we take this policy loan and die? It's important to know that that's not a debt that has to be paid off by our heirs because the death benefit is going to more than cover that policy loan. We can never have a greater outstanding policy loan than the death benefit on the insurance policy. I remember you telling a story about one of our clients who called in and wanted to know, should they really take a policy loan to put a new roof on their house?
He needed about $5,000 to put this new roof on his house, but then he was concerned because his death benefit would be decreased by $5,000. And I said, well, if you borrow $5,000 and you put on your new roof and you die, the next week, God forbid, your death benefit it won't include that $5,000, but your wife will have the new roof on the house. And it would be much better to receive $5,000 less and have the roof on and that all taken care of.
What you just explained, Michelle, is collateralization. The death benefit is the collateral for the loan. If the loan is not paid off and a death occurs, then the loan gets paid first and what is left goes to the beneficiary. If that money that was borrowed against the policy when it was collateralized is used for something productive like a roof or maybe a car or maybe to pay down some other debt, then that money was not lost when the person dies.
It's kind of like a home equity line of credit. If you take a home equity line of credit to put the new roof on, that's going to help maintain the value of the home. When you sell the home someday, that home equity line of credit is going to need to be paid off if you haven't paid it off already.
When we take a loan from our policy and the insurance gives us the money to use, then they basically have taken a collateral assignment against part of our death benefit. There are people that use their life insurance policies and go to a bank or go to a third-party lender, and then they have to do something called a collateral assignment. A collateral assignment is like going to a pawn shop and saying, okay, take my watch, hold it here, and I want to use some money. And if you don't come back and pay the money, they take your watch. It becomes theirs. The same thing happens in a life insurance policy. If you take a loan and you use your policy as collateral assignment and you die, the loan is going to be paid off with the death benefit, and the rest then will go to your beneficiaries.
You mentioned going to a bank, using the policy as collateral for a loan. That used to be a little bit more common when interest rates were lower a few years ago. If somebody could get a loan from the bank for 3.5% interest and their policy loan rate was 5% interest, then they might take their policy to a bank and use it as collateral assignment and get the loan at 3.5% interest.
From the bank.
From the bank. That's right. So that used to be a little bit more common. We're not seeing that with the higher interest rates now because those interest rates would be more like 8 or 10% from the bank, and you can get the policy loan for 4 to 6% in most cases. So why not just take the policy loan?
In fact, some of our clients who have done a collateral assignment of their policy at the bank to get that lower interest rate that the bank was offering, those rates started increasing. And so the clients just quickly made a switch. They had the collateral assignment stop. They borrowed from the policy to pay to the bank to pay off the loans that they had taken at the bank. So they just switched their position as the financial market changed.
And that's important to have a reserve to be able to do that, because if you tie up if you have your reserves all in policies that are collateralized at the bank and you want to make that switch, you still want to have the reserve to be able to make that switch.
We talked about taking policy loans, using your policy as a collateral assignment to get a third-party lender to loan you money. There's a lot of our clients that have done both of those things to build businesses to buy equipment, to pay the down payment on their homes.
They've done fun things like put in swimming pools for their family to enjoy, take special vacations. There's people who have started businesses, retail stores in California and Oregon. There's online stores. There's fabrication businesses, people who have borrowed to further their business, doctors' offices and automotive industry, the trucking industry.
People buying rentals for fix and flips or just for long-term rentals.
Or even
financing
buying
that,
their
or
first home because
putting-
they have enough cash value that's developed to just say, I'm going to borrow from my policy instead of paying 8% for a home mortgage right now.
or even making down payments on homes in cases where they didn't have quite enough to make the full payment.
There have been clients who they want the life insurance for their family. They like that they can put the money away, but then they also borrow to fund their children's education. They also pay it back. They get a discount for paying their tuition up front. So they're able to leverage their policy to reduce the amount that they have to pay out.
And this is where the infinite banking concept comes in. Yeah, we can borrow our cash values. Yes, we can pay it back at a lower interest rate. But when Nelson Nash wrote the book, Becoming Your Own Banker, the infinite banking concept, he said, you've got to be honest with yourself. If you've been paying 26% interest to somebody else, when you borrow that money from the policy, you should pay 26% back to yourself. Now, that whole 26% may not be able to go into that policy because it's only charging between 4 and 6%. And anything extra than that could be considered an overpayment of premium and get you into a tax situation. But that money is going to come back to you. And that's why the infinite banking concept is so powerful. We get this reserve, this cash value in life insurance to use with a lower interest rate than where we might have to use someplace else. And now if we're just honest with ourselves and pay what would have paid out somewhere else, we'll put more money back in our own pocket.
The cool thing about it is all of these things that people have financed and are financing, sometimes they do multiple things at the same time. You don't have to pay back a policy loan entirely before you can take another one. The insurance company just sees one big policy loan. So if you take out 2 policy loans and both of those are within your total cash value, you can do that just fine. The insurance company just sees it as one loan. You can see it as 2 different loans and pay them back on your own time schedule.
People that take policy loans, oftentimes they use those for investments. What if the investment turns south and they don't make a profit? How has that affected their balanced portfolio?
That's a good question. When people are taking policy loans for investment purposes, or even if they're not taking policy loans and they just have the money sitting there, that can still be part of their overall portfolio. In fact, as people approach their golden years, they typically want to have more of their policy loans paid back, have more of those cash reserves in life insurance, because their life insurance isn't going up and down with the market. Like you mentioned with the investments, those can go up and down. So what if they go down in a year or just a few years before you need to start drawing the money? That's a big downer. But having life insurance cash values, you know that portion of your portfolio is not going to go down. So it can be a great way to protect against market volatility.
So if the market goes down and you're starting to dip into the principal of your retirement funds, now you run the risk of running out of money because you're not going to be able to live off the interest like retirement funds are designed to do. That's the time to dip into cash values and say, I'm going to take from this so my principal isn't eroded over in my investment portfolio so that when the market rebounds, I can start living off interest again.
Having good life insurance improves everything that you do financially, including preparing for your golden years. Cash value is a derivative of owning permanent life insurance. Now that you understand what it is, how it works, and how you can use it, you are better prepared to acquire cash value life insurance and be able to use it.
There are a handful of ways you can leverage the cash value in your life insurance, but once you do leverage it, the ways you can use it are infinite.
Next week, we have a guest who started her own business, a cottage food operation. She bakes sourdough bread, bagels, cookies, cakes, pies, and she's going to be on the show telling us how she does it. If you have questions about baking, business, or anything else, send them to producer@wealthtalks.com so we can include them in the interview next week right here on Wealth Talks.
Bye.